Here to share his outlook, PIMCO Global Economic Advisor and former Fed Vice Chairman Richard Clarida. Rich, it's great to have you on. Thanks for being here.
Yeah, look forward to it.
So, you know, we have Chair Powell on the record a couple different times, essentially saying, you know, when the risks seem like, you know, they both maybe are a challenge to the employment mandate as well as the inflation side of the mandate, you have to figure out which one looks like to be the bigger risk at a moment in time. What's your assessment of that, and what's your assessment of the Fed's read on that right now?
Well, I think their read is that there is still a lot of uncertainty about tariffs. You know, the reality seems to change day by day, the court rulings. You know, the models tell them that if the tariffs go in place and stay in place, it'll both push up inflation, at least for a while, and push up unemployment. And so I think they came into the year thinking they were in a good place, and I think they're happy to sit on their hands and let the data come in over the coming months.
Does it still seem as if they can be comfortable in a wait-and-see mode at this point, just based on how some of the growth data have been? I mean, obviously, it's mostly held in there, but, you know, the labor market's decelerating. Housing market is kind of stuck.
Exactly. You know, I think that underlying GDP is probably running either at or north of 2%. Obviously, the first quarter was held back by the trade. And if you believe the Atlanta Fed GDP now, we could be looking at a gangbusters quarter. So average out, the economy is growing around trend or maybe a bit above. You know, and the inflation data has been good. Year over year, PCE inflation came in last week at 2.1, which was the lowest in 4 years. And I think on your labor market point, I think they expected the labor market to slow this year. Payroll gains running around 100,000, I think, is certainly something that they would be fine with. And of course, we'll get another payroll number on Friday. For sure.
I guess the question is how restrictive the Fed even thinks it is right now, with rates, you know, above 4.25 on the short end, and I guess if that's going to motivate them in one direction. You know, we heard Christopher Waller, you know, say that essentially he could see good news rate cuts coming if, in fact, the Fed treats the tariff price impact as transitory.
Yeah, I did see that comment from Governor Waller and other Fed speak, including, I think, Lori Logan today. You know, we had Tom Barkin last week also, so you've had a lot of Fed speak. I think they're comfortable waiting. I think there is probably a scenario for a so-called good news cut. I think that's really going to depend on what we see in the inflation data, and I think several Fed officials have emphasized the importance of getting some certainty about what the ultimate tariff program is going to look like, and right now, of course, that's up in the air. So that's another factor as well.
Yeah, I mean, it's a very good point, just how contingent it is, because, you know, it was a couple of months ago, or I guess you could have said, wow, the Fed is at risk of being behind the curve here if we're going to go to these maximalist tariffs. And then you can just dial back and say, never mind on the tariffs, and all of a sudden you have a very different economy.
Financial conditions, of course, are much more broad than just the federal funds rate. You've had a nice big rally in the equity market. You know, bond yields are more or less in the center of the range they've been in for the last year or two. Credit spreads have tightened. And so tighter financial conditions were the story a couple of months ago. Most of the markets seem to have digested the tariff and trade news pretty well so far.